As the name suggests, a non-bank lender now is something other than a bank. But since there is no harmonized definition of what a bank is actually globally, we had to take a step back and ask ourselves what actually a bank is.
These new group structures raise a whole host of issues such as data protection for consumers, and they also heighten both financial and non-financial intra-group interdependencies.
I'm Johannes. I'm Senior Advisor at the Financial Stability Institute of the Bank for International Settlements.
Hi, I'm Raihan Zamil, Senior Advisor at the Financial Stability Institute of the BIS.
And I'm Emma Claggett, speaking from Basel. You're listening to BISness, the podcast from the Bank for International Settlements. Non-bank financial intermediaries, or NBFIs, play a critical role in the financial system. They include all financial intermediaries that are not banks. Within this universe are a subset of firms with various business models that provide credit to consumers and small businesses. Former U.S. Fed Chair Alan Greenspan collectively referred to all NBFIs as the spare tire for the financial system. And this is because they have the potential to support the real economy when the banking system is under stress. But unlike banks, which have to comply in some way with globally harmonized rules under the Basel framework, NBFI retail lenders are not subject to any parallel requirements. So without any benchmark to assess the health of NBFI retail lenders, there's no assurance that they can continually provide credit to consumers and small businesses when they need it. Against this backdrop, and as non-bank lenders continue to proliferate, a key question for regulatory policy is whether, and if so, what sort of regulatory regime should apply to all such entities. My two guests today, Raihan and Johannes, recently wrote on this topic. In March of this year, they published an FSI Insights paper that takes stock of regulatory frameworks that apply to non-bank lenders in 20 jurisdictions. Based on their study, they proposed a framework to enhance existing practices. Thank you both for being here today. Johannes, what was the motivation behind this project?
Many thanks, Emma, for having us. It's a great pleasure to share with you and whoever is listening what we have learned in our journey for this project. And I can say without hesitation that we have indeed learned a lot. So why have we started this? So as you mentioned, NBFIs have become quite important in credit markets around the globe, and they are also quite significant now in important lending segments in some countries. So at the FSI, as you may know, many of us are former banking supervisors and we know quite a bit about banks. But once you move to NBFIs that compete with banks in the lending space, maybe we know a little bit less. And so especially also from the regulatory side. And this is where the idea for our paper came from, to look specifically at NBFIs that lend to households and small and medium-sized enterprises, SMEs. And we call these entities NBFI retail lenders. So what is the issue here? So the issue is that there are no globally harmonized rules for them, as you mentioned before, unlike for banks. And this also means that there are no international standards that could tell you, as a local regulator in the country, if and when you should apply prudential requirements to this type of entities. So this also means that the regulatory framework for NBFI retail lenders varies quite a bit across countries. And while taking it a step back, so what this means in the past, this was not so much of an issue because these entities were lending mostly locally. But now we see more and more firms that lend exclusively via digital channels. And for them, of course, it's a lot easier to lend also across borders. So at the end of the day, what we have is a business model that may become increasingly international over time, on the one hand, and on the other, we have local regulations with quite diverse requirements. But that's not all. How NBFI retail lenders do their business may also be changing. One thing is the use of these new digital delivery channels. But on the other hand, we also see new types of credit products, such as buy now, pay later products. And we also see the use of new technologies and alternative data that are used in loan origination. And on top, we also see big techs entering the space, and we see NBFI retail lenders that are part of much broader groups that conduct not only financial but also non-financial activities. So all of this is raising questions about the regulatory perimeter. It also raises questions about whether the regulatory framework that we have currently is fine, or if there are any gaps in it. And this is what we wanted to look at for this paper.
So how do you define an NBFI retail lender? How is it different from a retail bank lender?
Yeah, so this is a very good question, and frankly, it took us quite a bit of time to figure this out. So maybe let me take a step back. So the issue is that the universe of NBFIs is huge and includes all sorts of different financial intermediaries that are not banks. So for example, there are firms that are subject to traditional financial regulation, such as insurers and securities firms. But then there are NBFI retail lenders that are subject to a patchwork of regulatory rules. And this group includes, for example, finance companies, mortgage lenders, but also other types of consumer finance companies. What it also includes is new entrants, and here we have fintechs and big tech lenders. So it turned out that it was quite difficult actually to define this type of firms. But as the name suggests, a non-bank lender now is something other than a bank. But since there is no harmonized definition of what a bank is actually globally, we had to take a step back and ask ourselves what actually a bank is. And I have to say this was also a quite interesting exercise to do for us, that we have both worked many years already in banking supervision to ask ourselves what actually a bank is. So we found that there are broadly 4 approaches how banks are defined. The most common definition of a bank is in relation to deposit taking and lending, so this combination of these 2 activities. Then in other countries, the definition may refer to a combination of lending on the one hand and on the other on either deposit taking or soliciting other repayable funds from the public. So this is one other approach. Then a third approach is where deposit taking as a standalone activity triggers the need for a banking license. And lastly, there are also some countries where both deposit taking and lending are designated as banking business, and therefore each of these activity alone would need a banking license. So once we know what a bank is in a given country, we then can say whether retail lending activities can be performed by NBFI retail lenders, and also if they are subject to the banking regulatory perimeter. So to make things even more complicated, we came across several countries where NBFI retail lenders are actually allowed to take deposits. So I have to say this puzzled us first, because deposit taking is typically associated with banks. But at a closer look, it turned out that these entities are typically not allowed actually to offer demand deposits, so they cannot offer current accounts to their customers. And this is also how authorities differentiate deposit-taking NBFI retail lenders from banks in their jurisdictions. So based on all of this, in the end, we came up with a definition of NBFI retail lenders and defined them as firms that first engage in lending by using their own balance sheet. Then second, they are not able to accept demand deposits. And third, they are not insurers, securities firms, or pension or other investment funds.
Raihan, what's the case for regulating non-bank retail lenders, and in some cases, their parent companies?
As Johannes mentioned, there's quite a bit of overlap in terms of the activities of banks and NBFI retail lenders. And as a consequence of that, they're subject, that is, NBFI retail lenders are subject to a similar set of risks as retail banks, like your traditional credit, liquidity, operational, and cyber risks. But just because they're subject to similar risks as banks does not necessarily justify the imposition of bank-like prudential requirements. And to kind of answer your question, the case for prudential oversight of NBFI retail lenders may arise first when the scale of their retail lending is significant from a domestic standpoint. Second, and this refers to what Johannes mentioned earlier, they're allowed to accept retail deposits or their functional equivalent, because in some jurisdictions we found that they don't call it retail deposits. They have some other name, but de facto they're soliciting funds from retail consumers. And third, the third case would be is when they originate mortgage loans. And why mortgage loans? Because they're probably the most consequential investment that households make, or offer digital loans, which introduce new risks to consumers. So these would be the three different methods that could trigger some form of bank regulation. Now, beyond this, new group structures have emerged, such as when a financial or a non-financial group is the parent company of an NBFI retail lender, for example, and a payments provider. And usually when you have this kind of conglomeration, there's a very good chance that they fall outside the scope of existing group-wide supervision frameworks. And so just to kind of illustrate the point, if you look at technology-led financial groups that include NBFI retail lenders, they introduce new risks to consumers in the financial system. Why is that? It's because the effects of combining an NBFI retail lender's credit underwriting with other financial and commercial activities of the group. So just to provide sort of a concrete example, the NBFI retail lenders loan customers and the credit underwriting they do could be heavily drawn from the consumers and small businesses who use the parent tech firms, other social media, or e-commerce platforms. And there could be other types of interdependencies with subsidiaries of the same group, such as, for example, IT system sharing arrangements. And these new group structures raise a whole host of issues, such as data protection for consumers, and they also heighten both financial and non-financial intra-group interdependencies. And all of this may not have existed to the same degree under more traditional financial conglomerate group structures that probably warrant some form of group-wide oversight.
So what's the current state of play in terms of regulating NBFIs?
Yeah, so in a nutshell, we found that the regulatory landscape for NBFI retail lenders varies quite a bit across countries, but in many cases they are subject to licensing or registration requirements. So in some countries you may see individual monoline licenses, and they would be necessary to carry out specific types of lending. Could be for consumer or mortgage credit or credit card lending. Could also be for newer types of credit like BNPL. Then in other countries, you may see omnibus or single omnibus licenses, and these licenses would allow NBFI retail lenders to carry out the full spectrum of retail lending. But then there are other cases, other countries where there may not be any license required, and here maybe only registration requirements with the relevant authority may be in place. And this could also be for AML CFT purposes. So then there are also cases where NBFI retail lenders are outside the regulatory perimeter, and here they would be only subject to general consumer protection requirements, and this could also be in the form of caps on the interest rate that can be charged for this type of credit. So as the regulatory scope for NBFI retail lenders may not only be defined by lending activities, but also by looking at their funding source, particularly deposit taking. And as I mentioned before, in some countries, NBFI retail lenders are allowed to accept public deposits. But as we found out, there are certain restrictions and conditions attached to this. And the most common one is that NBFI retail lenders are not allowed to solicit demand deposits or issue current accounts. But in addition to that, there are also other restrictions, and they could include minimum size thresholds for deposits, or also caps on the interest rates that this type of lenders can offer on term deposits. So overall, we found that most countries actually have not implemented a systematic approach to the prudential oversight of NBFI retail lenders. But on the contrary, that regulation has often been implemented in a quite piecemeal fashion, with expansions to the perimeter on mostly ad hoc to capture emerging lending activities.
Okay, so I wonder if you could talk a little bit now about what some of the challenges are in determining whether non-bank retail lenders should be subject to bank-like regulatory requirements.
Yeah, as Johannes mentioned, he provided a good lay of the land in terms of the different variations in regulatory approaches across the jurisdictions that we looked at. But what's interesting is that despite these variations, all authorities face a similar set of challenges. And broadly speaking, there are three main challenges. So first, there are data gaps in terms of the types of NBFI retail lenders that operate in each jurisdiction and the nature and significance of their activities. And these gaps may hamper efforts to determine an appropriate policy response. And second, as Johannes mentioned, most jurisdictions take an ad hoc as opposed to a systematic approach to the oversight of NBFI retail lenders. And in addition to data gaps, this could be due to the dispersion of responsibilities among the various authorities that have oversight responsibilities for the oversight of NBFI retail lenders. And these factors may have contributed to the lack of visibility over market developments, including the rapid growth and proliferation of novel business models and group structures. And some of these novel business models, such as buy now, pay later, have been structured to explicitly evade existing rules, which again prompted ad hoc policy responses by some jurisdictions. And last but not least, the ways in which NBFI retail lenders affiliate with broader financial or non-financial groups have allowed the group entity to operate outside the regulatory perimeter, again, prompting an ad hoc policy response by some authorities. And they did so to ensure that their existing group-wide supervision frameworks remain fit for purpose.
So from your vantage point, what do you think an ideal way to regulate and supervise non-bank retail lenders would be?
Yeah, all authorities, we think, can benefit from developing a more holistic approach to the oversight of NBFI retail lenders, which from our vantage point, we think should contain three main elements. First is to develop a framework for the firm-specific oversight of NBFI retail lenders. And in determining the type of regulatory requirements that are needed, we think authorities need to consider an NBFI retail lender's significance, however they define it, their ability to accept retail deposits or some functional equivalent, and the nature of their lending activities that have a particular bearing on consumer welfare, such as mortgage lending. Second, we need to ensure that emerging group structures that blend financial services, data, and technology, such as when two or more NBFI retail lenders are owned by fintechs or big techs, are subject to group-wide supervision. Third, we need appropriate institutional arrangements that can support firm-specific, group-wide, and macroprudential oversight of NBFI retail lenders. And this is going to require cooperation across various silos. So this would include prudential, conduct of business, data privacy, operational resilience, and competition authorities to accommodate these new forms of financial conglomeration. And this is mainly because the aggregate activities that are conducted in these new conglomerate structures give rise to risks that cut across various policy domains. And collectively, we think this is probably the best way to make sure that the financial system's spare tire that you mentioned, Emma, at the beginning, is regularly checked for holes and the right amount of air pressure so that they can continue to fulfill their critical role in providing credit to underserved consumers and small businesses.
Well, thank you, Johannes and Raihan, and thanks everyone for listening. You can read about this topic and more on our website, BIS.org. Do subscribe to BISness on iTunes and Spotify, and follow the BIS on X, LinkedIn, YouTube, and Instagram.